Hello and welcome back to Money Never Sleeps. My name is Mac from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. Today we'll be talking about the behaviors that could quietly undermine everything you've worked so hard to build, many of which catch a lot of people off guard once they get into retirement. We're going to walk through 7 investment behaviors that, according to a recent article from Kiplinger, tend to hurt retirees the most. These aren't obscure technical mistakes. They're patterns that feel completely reasonable in the moment, but that could add up to real costs over time. Throughout the episode, we'll be drawing from that Kiplinger article titled, "These 7 Investment Behaviors Hurt Retirees the Most, but It's Not Too Late to Change Your Ways." According to research from Morningstar cited in the article, behavioral mistakes could cost investors an average of 1.2% annually. Over a long retirement, that drag can add up. The encouraging news is that most of these mistakes are behavioral, which means they can be addressed. The first behavior is holding too much cash out of fear. Keeping an emergency reserve is prudent. That's not the issue. The issue is when fear pushes a large share of a portfolio into cash for years at a time. Inflation is slowly eroding what that cash can buy, and after taxes, a lot of cash yields can struggle to keep pace. So, what feels like protection could actually be a slow, quiet loss. The approach that could work better is defining a clear purpose for cash. In my experience, many financial services professionals suggest holding 1 to 3 years of planned spending in cash or short-term bonds, then investing the remainder with longer-term goals in mind. When cash is tied to a specific time horizon, it can reduce anxiety rather than amplify it. Cash without a defined purpose could grow until it's doing more harm than good. The second behavior is timing the market instead of staying invested. Selling after a decline feels protective, but it often locks in losses and increases the likelihood of missing the rebound. Research from Hartford Funds cited in the Kiplinger article found that missing the 10 best days in the market could reduce returns by more than half. 10 days, out of years and years of investing. Adjusting allocations deliberately potentially serves retirees much better than jumping in and out based on headlines, and it's important to remember that volatility isn't the same thing as a permanent loss. Retirement planning is largely about avoiding the combination of a portfolio decline and forced selling at the wrong time. A decline you ride through is very different from a decline you lock in. Number 3 is ignoring tax efficiency in withdrawals. In my view, not all retirement dollars are taxed the same way. Money in taxable brokerage accounts, traditional IRAs, and Roth IRAs each behaves differently when you pull it out, and the order in which you draw those accounts down could significantly impact what you actually keep after taxes. A general approach that works well for some retirees is to start with taxable assets, coordinate tax-deferred withdrawals, and preserve Roth flexibility for later years when possible. But the right approach is personal, and everyone's income mix, account balances, and family situation are different. In my opinion, what matters most is having a plan in place before required minimum distributions kick in and before Medicare premium surcharges complicate the picture. Those distributions are mandatory, count as taxable income, and could push you into a higher bracket with Medicare premium increases to follow. To me, waiting until that happens to think about tax strategy can leave fewer options on the table. Even a fairly simple plan could be meaningful. Decide in advance which accounts are for baseline spending, which are for one-time expenses, and which are the long-term backstop. Give us a call at 866-973-3627 or visit us online at mnawealth.com. We're always happy to work around your schedule. The fourth behavior is chasing yield without understanding the risk. A high distribution rate looks appealing, especially when markets feel uncertain, but yield is not a free lunch. Prioritizing yield in fixed income or income-focused holdings without understanding what's underneath could mean taking on credit risk, interest rate risk, or concentration risk that doesn't reveal itself until things go wrong. A more durable lens is total return. If a holding described as high income could drop 20% in a bad year, that income may not be the safety net it appears to be. The goal is reliable funding over the long run, not just a high distribution rate in the short run. The fifth behavior is failing to rebalance consistently. Without rebalancing, risk drifts. After bull markets, portfolios could become more stock-heavy than intended. After downturns, some people end up more conservative than their plan calls for. Research from Vanguard cited in the Kiplinger article suggests systematic rebalancing could help maintain intended risk levels and improve outcomes over time. It doesn't have to be complicated. Rebalance annually or whenever allocations drift past a predetermined threshold. And if you're regularly pulling money from the portfolio for living expenses, those withdrawals could be used to rebalance in a tax-aware way. Drawing from an overweighted area to fund spending reduces the need for separate rebalancing trades. That's one action with two results. The sixth behavior is overreacting to short-term news. Retirees who monitor their portfolios daily could feel more stress and potentially make more reactive decisions. A more practical approach is a consistent review schedule, quarterly or semi-annual check-ins, paired with a written investment policy statement that spells out what you'll do during volatility. That document gives you something to return to when emotions are running high, a set of decisions you made when you were calm that can guide you when you're not. If you find yourself wanting to do something because markets are down, that could be a signal to return to the plan first and ask whether anything has fundamentally changed. The seventh behavior is neglecting to adjust strategy over time. The portfolio that made sense at 65 may not be the right fit at 75 or 85. Time horizon, spending needs, and health all change. The article mentions the 100 minus your age rule as a blunt but useful reminder to revisit allocations periodically based on actual cash flow needs and not what made sense years ago. It could also help to revisit what different parts of the portfolio are meant to do. Some assets are for spending, some are for legacy, and some serve as a buffer against a very long life. Those roles can shift as time goes on, and the allocation should be able to shift with them. A periodic annual review where you ask honest questions like, has my spending changed? Has my health changed? Are my goals the same? Goes a long way. Remember, retirement isn't a fixed destination. And that's really the thread that runs through all 7 of these behaviors, having a plan and staying committed to it. The biggest risks retirees can face are often behavioral, like holding too much cash because it feels safe, selling when fear takes over, skipping rebalancing because it never felt urgent, or not adjusting as life changed. Each of those on its own may seem manageable, but they could compound, and in retirement, compounding errors potentially matter more. The article closes with a simple framework worth keeping in mind. Set a cash reserve that matches real spending needs. Commit to an allocation you could live with during a downturn. Build a withdrawal plan that considers taxes. Rebalance on a schedule, and review your portfolio less often than your emotions may want you to. If you were to do just one thing, write down the plan while markets are calm and use it as your decision filter when they're not. Having a written plan is what separates people who stay the course from people who don't. If any of this resonates with what you're going through right now, or you just want to make sure your plan is solid enough to hold up if something unexpected happens, we'd love to hear from you. Visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for. We'll see you next week on Money Never Sleeps. Take care, everyone.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.